Hey everyone, welcome back to the channel. I'm Doug, the retirement guy with all your monthly ETFs. Today, we have the 7 high yield dividend ETFs that pay out monthly that have no NAV erosion. We try to do this on a fairly regular basis because the funds will change as market conditions change and as the geopolitical side of things have changed. But today we're going to give you 7 high yield dividends that you can pretty much start banking on and working accordingly with. Now, I'm coming back to you. We've been on a little bit of a vacation, so we're a little behind on our videos, and that is because you need to take time with your family and your loved ones to enjoy life on this journey. Let's get into today's video to help you out with the 7 high yield dividends with no NAV erosion. But before we dive in, please remember I'm an investor, not a financial advisor. This information is for educational purposes only. This is based on my own strategies. Always tell everybody, do your own research. And if you have financial advice that you need, always talk to a professional financial advisor or a professional tax advisor. So one of the big questions I get all the time, really, what is NAV erosion? Because on YouTube, that word is used across the board. People use it for a stock market that takes a little bit of a downward turn in a day. Ooh, NAV erosion. It's a keyword that they use, but the real answer to it, the NAV erosion is when the net asset value erosion occurs when a fund pays out more distributions than it earns from the underlying strategy. It's watching the net asset value decline over long periods of time. So what we call this is the principal trap. It's a high yield is meaningless if your initial investment, your principal, is shrinking faster than your income payments. A lot of people seen these with the weekly payouts that they're saying, oh, I'm making big yields. But this is why we always tell everybody to watch your total returns. They tell you the true answer. Destructive return of capital. Now, a lot of people will argue with you, return of capital. Oh, that's a tax advantage service. Well, it is if your total return is in line and your dividends are in line. And sure, that's a great tax advantage. But when you start into this and you start seeing that your yields are higher than your total returns and you're starting to get your own money back, you're actually facing a total return of capital. So I put it on a chart over here. You can see how a high yield fund, which is very common with high yield funds, start out at a certain point and over a long period of time, they will lose their value across the board while still paying out big potential income. And it gets people into what we always call the yield trap. So what you have to watch out is high yield doesn't really mean much. It's the high total return that we're actually looking for. And then you have to break your total return down to, is it growth that's coming from it, or is it actually yield that you're getting out of it? So it's a little unique, different way of looking at things that we have to address. So here's a comparison that I did. I thought this was really unique when a couple of my Patreon supporters talked to me about really the Russell 2000. IWMY is from Defiance, and it has a weekly payout and is a very aggressive weekly payout type fund. Now, IWMI comes from NEOS. Now, you'll also hear a lot of people talk, it's all about the underlying asset. Okay, so basically is what the fund is buying into, how it handles it, and what it does. Well, this is why I did this comparison. Both of these are working off the same exact underlying asset, but you're getting two totally different reviews and different answers from it. IWMY is down over 30%, while IWMI is up over 15%. Why is that? It's the strategy that they're using. They're using an aggressive strategy with that weekly pay of IWMY. It puts that burden on them that they got to pay a dividend every single week. So they aggressively are doing different things to generate that income. While IWMI from NEOS is a more balanced structure, balanced strategy, pays out monthly, and it works better in most systems. Now, assets under management, 658, because people are excited about the high yields and the weekly pay. So it's a bigger advertising point. While IWMI from NEOS has an assets under $100 million, but they have a substantial increase in value versus losses. So you can see the strategy between particular funds and what they do means more of how it operates. Because if you have the apples for apples, same underlying assets, and you have two different strategies, you get two totally different reviews and two totally different results. So let's take a look at the top 7 funds that I have found. And this is one thing, I'm not dialing into S&P 500s. I'm not looking at NASDAQs. I'm trying to find something other outside of those funds because we all know those funds normally hold their own across the board. The first one we come up with, and you've heard this on our channel before, and this is going to be the Kurv Silver Enhanced Income. Now this one has a targeted yield between 18 and 20%. It pays out monthly, and it works off of the silver calls. It does covered call writing. It generates massive income from its silver's high volatility without liquidating the physical holdings. The capital appreciation structure is the captured price movement in silver while acting as a hedge against the concern currency. Sorry, cold is kicking in. And we also have no NAV erosion with this fund. So let me show you one more. So KSLV, we look at this one. Shares already of 2.45 million shares already outstanding. Now I do want to say, since inception, this thing come out September 29th of 2025. So it does not have a full year under its belt. But it's really been making headway. We've talked about this on the show many a times. A $3.05 payout when just only since September for a 7.44% dividend yield. Most people will look at that dividend yield and just kind of, okay, move on. Nothing big or spectacular. But they don't do their research. They don't dig deeper into it to look at this and say, this has only been out since September. So when we take a look at a hardcore of dialing it down into more numbers, a year to date, which is January 1 to all the way here to March 12th, so really about 2.5 months, 21.8% total return in performance. Okay, that's total return. So that's your dividends, your growth, all tied into one big report, which is why we watch these numbers. So when we take a look at the growth at 16.87% for the year to date so far, 7.44% yield, a total return of 21.8% for year to date, this makes silver a very strong piece in the marketplace. We look at the charts, and if you're a chart reader like myself, you'll see it had a big spike in late January, early February, to getting up to almost $60 a share. It has tapered itself back down after the little, scare in silver and everything that goes on with the politics across the board, back down to a base of about $40.99 per share. So it kind of puts us more into a playing market. Our next one's coming off of Kurv again. And this is, again, another one of these. Gold and silver are the premium products that people are buying because the market is uncertain. We don't know where it's going. These are key factors that you can put into a portfolio to help you down the road. The key Kurv growth and enhanced income, a 10 to 15% targeted yield, a monthly payout, and again, it's a gold covered call. Very similar to what we just talked about. So this one here it's hedging itself. It has a balanced exposure, and it sustains the payouts, avoiding aggressive NAV decay in those high yield competitors. It captures gold price appreciation while selling options on the fund's distributions. Let's look at this one a little closer. Now we pop the hood on KGLD. Again, 2.66 million shares. This one came out July 8th of 2025. So just like Kurv's silver program, this one's just a little bit older, given a little bit more time under the hood. So dividends paid out 2.45 or 6.83% dividend yield. So again, it's not been a full year, paying out monthly. But look at again the 21.48% total return year to date. That's from January to current day of March 12th. They've had growth in that same period, 17.63%. So this is a nice growth-orientated fund, giving you a total of 21.48%. You add in the yield that's coming in from those numbers, and you can see basically that this fund is more driven towards growth than income. That's why we say you find what the total return is, and then you realize, does it a growth or is it an income play application? And I'm being honest with you, KGLD, gold is very hard to make money off of because it's a commodity. It's just a commodity. You're buying a brick of gold for a certain price. It doesn't generate anything. It's not like a company that generates income or anything like that. It's as the price goes up, you can sell it and make a profit. And that's how these guys are selling their covered calls. So for someone in a retirement program or a retirement package that you are, this is one of your pieces that you put into your growth factor. It's going to give you some income, but it's primarily based off of growth. Our next fund from NEOS, this is their Real Estate High Income, IYRI. Your yield's going to be between a 10.5% to 11.5% monthly, and this fixes into the REIT category. Now, the REITs, if you don't understand what that is, that's Real Estate Investment Trusts. Okay, so these guys are buying into multiple different packages. I know we show a house here on the picture, but they may be investing into office buildings. They may be investing into e-commerce fulfillment centers. They may be into FedEx fulfillment centers, UPS. There's a lot of places that these guys can put investments, and it's all classified as real estate. This one gives you more diversified exposure. It invests in the top tier real estate investment trusts or REITs, diversifying their income sources beyond anything in tech. Which is why I thought we'd do this video, is that we don't always need to be looking at tech. We can look at diversification, and that would be into real estate and other markets that you've seen, silver, gold so far, and now real estate. This is Driven Options. These guys use a proprietary option strategy to enhance yield while aiming to reduce volatility in real estate sector. The steady income provides that consistency of 10 to 11% in yield, acting as a stabilizer in broadening your income portfolio. Now, I put down here some of the things that they're invested in. Welltower, Simon Properties, Equinix, and then also the Realtor Income. Now many of you probably have heard of O, but you don't always look at what they have. You could take these four and dial into what they are actually investing into and realize that you're away from homes. You're into so many different markets and so diversified. So now when we take a look under the hood, IYRI, this one here, again, 4.8 million shares outstanding. It's paid $5.59 in distributions. This one came out January 14th of 2025. So technically our dividend yield will be based off of a full 12 months at 11.43%. When we take a look at the year-to-date total return, 2.31%. Housing industry, we're in a market that's questioning. We've had so many things happen in the world just lately. We have basically invasions of 3 different countries. Okay, we're doing a lot of stuff outside that's got the world questioning. What are we doing? We've had tariffs. We've had we can do tariffs, we can't do tariffs. They're all over the place. So the real estate has been on hold. They're waiting for what? Industry to do more, interest rates to change, and this is why the market has been slower on the real estate side of it. When we look at this thing farther out, and this is why I always do this, is you got to look farther out, 1 year and since inception, 7.65 total return and 8.16 respectively. So are we on track? Yeah, we're definitely on track for a normal operating season and operating year. We're up 2.31%. These are not going to be the super high people looking at 20, 30 plus percent. But what we're seeing so far, because we're dealing with year to date, Long term, 12 months, your yields are going to be in that 11%. Growth is going to be all over the place. So this one is really a yield income. This is one that's in creating income for you. That's why the 2.31% may not knock you off your sleeve. It may not say, oh, this is great. Remember, this is year to date. But what's happening is the fund gives you great cash flow with the potential of some upward growth across the board as the markets and as the economy takes a change to the better. Now our next one is from NEOS. It's the Energy Infrastructure, MLPI. Now I'm excited about this fund. I've invested money into this one. I've added quite a bit of shares into this. So I don't want to mislead anybody in any way because I want to tell you up front, I have invested in this. I like the 12 to 15% targeted yield. This thing has a tax form of only using a 1099, and I'll explain that in just a second. And then its top holdings is ET and EMB. Now, the simplified taxation of this thing did. MLPI represents as a master limited partnership. So it's a little different than, basically MLPs is you're being a limited partner in an investment. But they're able to bring that to you in an ETF form without the headache of a K1 form. Now, if you've ever done this before, K1 form is just like filling out a 1040 form. So sit down, do your 1040. Now, before you turn everything in, you got to fill out another 1040, which is K1 form, for just one of your investments. So NEOS was able to standardize it into a 1099. They use a multi-stream focused, and it captures the income from what we always call a toll road business model. So pipelines, storage, it's less sensitive to oil pricing swings. No matter what the oil price is, you're still going to have a cost to get that oil from point A to point B. And this is where this infrastructure really comes into. It's an enhanced income. It uses options overlay strategies to boost the natural yield of the energy sector to that 12 to 15%. So it's unique how they do this. MLPI, net assets about $46 million. In its piggy bank so far. It has 6.53 million shares outstanding. Now, distribution. This thing came out December 18th of 2025. So again, we're very, very new in this application. So 1.99% or $1.99 in dividends and 3.55% distribution yield. This is why I set this whole video up to look at things at year-to-date numbers. How have we done in the first 2.5 months of the year? So we take a look at this one, 14.98% growth, total return. That's given us a nice growth with a potential of a strong yield. When I say that, break it down. Year to date, we've had 11% growth already. We've also had that 3.5% yield for a 14.98% total return. So this one's a little more in the growth side of it, with yield is slowly catching up, getting to that 12 to 15% return. So if the growth continues the way it's been, and we can see now it's starting to settle out at the higher $55 price range, so I don't think the growth is really going to hold at these big numbers for the whole year, as we're going to start to stable out, but we're going to get income coming in. So this one I'm going to call it a 50-50 mix. You're going to have some good solid growth, and you're going to have some good solid yield across the board to give you that 14.98% total return. Our next one is one that we talked about at the beginning of the show, the NEOS Russell 2000 High Income. Now, I did not do the S&P 500. I did not do the NASDAQ. I did the Russell 2000 for a reason. A 14% to 15% targeted yield. Monthly distribution. Small cap options are taking over the business. They are growing. As we sit with the stagflation and the possible with the recessions and everything else going on, small caps have still been the strongest market out there. And this one here, it's a small cap focus. It targets that Russell 2000 The fund goes after that Russell 2000 index. It provides the diversification into smaller, growth-oriented companies often missed by the S&P 500. The manufactured yield, since small caps rarely pay dividends, IWMI uses a data-driven option strategy to generate significant monthly income. It's a capital appreciation. It's designed to capture the upside while avoiding any NAV decay during an aggressive daily payout. Now, IWMI, again, $658 million. This one came out June 25th of 2024, so we got some time under its belt. 13 million shares outstanding. Now, this one I'm going to tell you, 12-month rolling, 14.4% dividend yield. Now, lately, because of everything that's happened in the marketplace, everything that's happened in the geopolitical stuff, it's taken a step back a little bit with its growth, down 2.2% over the year to date. And that has affected the total return down to 0.14, still a positive number. This is why you got to look long term. 24% 1 year, 12% since inception. Yes, 1 month it's down 5.42%. What does these things tell you? You have a solid core. It's not a problem with the product. It's a bad news from the press and what's happening in the environment. Is it a buy package? In a lot of ways, this becomes kind of some of the tickets that say it's buy when we're into these type of modes. But this is not NAV erosion either, because you have year-to-date growth. You're covering everything fine. You have a price dropping because of environment control right now. That is the war in Iran. That is the increase in oil costs, and these are what's happening in the marketplaces. Now, HCOW, our amplified cash flow dividend. This one is a free cash flow. This one uses the health and energy sectors, has a 10 to 11% targeted yield. It's a quality filter. It targets companies with high free cash flow, indicating strong financial health and ability to pay dividends. It's a mature and stable. It avoids speculative growth stocks in favor of established profitable business and has a very low volatility. When we look at this one, again, I know you're going to say, oh, red, stop. This one came out September 20th of 2023. We look at the 1 year and since inception at 10.88 for 1 year and 6.93 total return so far. Everything we see so far, everything that we've dialed into, we see this is a holdback. This is a economy holdback. People are not going to grow as quickly. They're not going to invest the money that they need to invest. They're holding back because of what's happening in the economy. This one has not had the NAV decay, and I think it's one of these long-term plays I think has potential for down the road. Now, it has that negative 3.37% in growth. It does have a nice 11.62% yield, so it is an income-based product. But you also have to always take a look at that total return, down 0.94%, and that's only since year to date. So this is just an option of a play, still showing this is not NAV erosion. This is a market fluctuation, and it's down in a market. Our final fund is going to be the Amplified Energy and Natural Resources. You can see the trend that we have here and where the markets are heading. When you step away from tech, where's the next thing to go to? Energy. 10% yield, a 1099 form again, because we're dealing with energy. We're dealing into that whole market. This one has a hybrid energy exposure. It invests in both old energy, gas and oil, and new energy, clean and renewables. Has an upside potential, writing covered calls on 80% of its portfolio, leaving 20% of it uncovered. That's a huge factor to this. And it's a very tax efficiency, as we talked about with the MLPs. When we look under the hood on this one, probably one of the most impressive ones that we've had in the list so far. This one came out August 24th of 2022. Okay, 625,000 shares outstanding. So this is kind of one of those keep it quiet. Not everybody knows about this one. Because People are always looking at high yields, and these guys don't show high yields. They show a 4.76 over a trailing 12 months. Where do they get their excitement? Growth. 28.3% growth year to date only. That's 2.5 months. Total return, 2.5 months, 32.34%. Majority that's coming from growth. 1 year, 33.53%. So you can see that this one's had a massive growth over the past 12 months, equal to what it's done in the past 2.5 months. Last month, up 9.57%. Since inception, 16.03%. So NDVI has the potential for a big growth potential across the board because of the growth in energy. So give me quintile of everything going on, the comparison across the board, the performance of these ETFs, everything's coming around. You can see gold and silver have had some very big, strong, since inception, total returns. Yield, you can look at yield. Everything's in double digits. That's about all I'm going to say to you is because we don't chase yield on this channel. And we look at the expense ratios. That's how much of your money is actually going to work for you. So we got 1%. Basically, it's 1% of your investment. So if you invested $100, $1 is going into their cost structure, $99 going to work for you. So the lower expense ratio means more money you have working for you. So overall, I say the top performers is really in those commodities as silver and gold because of the way the market's been. The cost efficiency, NDIV and HCOW are really low cost at that low expense ratios. And the steady incomes, again, IWMI and NDIV. I'm really impressed with what I've seen so far with the energy sector and the small cap markets. So closing, key takeaways. Diversify your income sources. Don't solely rely on mega cap tax or S&P 500. Spread your portfolio out using gold, energy, real estate, small caps, and that helps you slide through markets that we're currently in today. Avoid NAV erosion. Okay, that is the killer of every fund, NAV erosion. And inspect the strategies. How are these guys doing? Are they using covered calls? Are they using put options, leverage? Understand how each fund works. So I asked the question, which of these 7 funds are you adding to your portfolio, if any? How many of you are holding some of these funds? I'd love to know where you guys are at and how it works in your markets. Let me know. Leave a comment below. And don't be afraid to hit the subscribe button. We keep adding more and more people. And I'm glad to be back with you in this video.
Thank you for watching. Press the